Right, welcome back. Now let's just let me sit up straight first of all. I'm disappearing in this great big chair. Let's just stop and have a look at what we did then. In part one, we talked at some sort of length about consolidation, about the principles and when you should consolidate and when you shouldn't. Part one was really aimed at, I think, paper P2 if you're an ACCA student, or from my perspective, for people working in government, trying to work out which government entities should be consolidated and which shouldn't. Part number two then worked on to the basis of how to undertake a consolidation when you are purchasing 100% of the shares. So in part number two, we had an organisation, it was purchasing another organisation, and what would the consolidated balance sheet look like? Part number two also concentrated very much not on the accounting, not on what are you doing, but just on the approach. How to lay the thing out on a piece of paper, how to fill in the numbers, and how to get the answer down on paper in 45 minutes. And that is the key to the whole thing. If you are a paper F7 student, that is what you really need to know. Part one of these lectures is nice to listen to, and if you're bored one day, have a listen, you might learn something. But part number two is by far the most important part. If you are coming to part number three as your first point of entry, can I strongly recommend that you take 20-30 minutes to watch number two, because I'm just going to bash through this first stuff, because now I'm repeating again things I've already said. So I do strongly recommend, therefore, even if you're thinking, no, but mine has non-controlling interest in it, minority interest in it, watch part number two first, because it will tell you most of what you need to know, and then come back to this. I will, however, go through these things again for those of you who have come late, if this were my classroom. So, very quick recap from part one, and those of you who watched part two have seen this slide already, so I'm going to keep this very, very short. We have to undergo the consolidation procedure wherever there's a business combination by acquisition of shares. We don't do it when we're just buying the assets. If we buy the assets and we don't take the shares, then those assets just go into our balance sheet at cost, and it's not required where there's a liquidation. Right, that again, if you are doing paper P2, is important information. If you're doing F7, where you will have to do it is in your exam, okay? And this is what you're learning as part three here, is how to do that in the time and manage it to get 51% of the adjustments correct. Right, this is the critical part of the information. What is it that you do? For F7, remember, all you're interested in is getting 51% of those marks and getting through this exam. Right, the way to approach these questions, therefore, is draw up your worksheet with your 4 columns. You've got P, which is your parent company, S, which is your subsidiary company, you have an adjustment column, and then you have your consolidation column. Just simply write in the balance sheets of the parent and subsidiary. You do this because you need them anyway, but mainly because 30% of the marks for any question are on numbers that do not change. The minute that you just fill in those two balance sheets, even if you haven't got a clue what you're doing, you've got 9 of the 30 marks. You only need 15 to pass the bloody thing. So, on a separate piece of paper, step number 3, calculate the net assets at the date of acquisition. If you're doing the balance sheet at a later date, now this for F7 will normally be the case. The guy will tell you that the year end is 31st of December and the acquisition took place on the 1st of July. So you're going to have to do net assets at the date of acquisition and the net assets at the balance sheet date. Do that on a separate piece of paper. Once you've done that, you can calculate your goodwill. Then we simply go in and we put the adjustments in. We take out the investment in S, we take out S's share capital, we take out S's retained earnings at the date of acquisition, we take out any other intercompanies between the two, and there will be some goodwill that go in there. I'll show you what to do with the non-controlling interest in a minute. Okay, so I strongly recommend that you print these off if you're going to work through them as well. But look at what we've done. Now, this information isn't given to you anywhere. I'm giving you the basic total information here. What we've done, therefore, is that we have written out the balance sheets of P and we've written out the balance sheets of S. Notice, therefore, things that should jump off the page at you immediately is that P has an investment in S of 120,000. Right, that has to go. I will tell you that those of you who watched part 2 is that there's going to be some fair value adjustments as well, and the fair value adjustments will be the same as they were in the last one. You'll see those in a second. Right, your piece of paper should now look like that. You will have to go through a process of copying those things in. I've done them for you already here. And slide number 5 is just more of the same. Slide number 5 is quite simply the liabilities and equity section of the balance sheet set out. Once again, notice that we have our 4 columns, and that is how you're going to approach this thing. When you're looking at this, therefore, notice that as well. We have our ordinary shares, so you will remember that S cannot have ordinary shares, they have to disappear, and S cannot have a retained surplus either. If those profits represent profits that were earned before the date of the acquisition. Anything which is earned after will stay. So therefore your ordinary shares have to slip out and your retained surplus has to disappear as well. Okay, right, do notice when you're doing these things to leave space as well. There is going to be a goodwill calculation, so in the asset section, which was slide 4, you're going to have to write in some goodwill, so leave a few spare lines. And at the bottom now here, there's going to be some non-controlling interest, because you were told that we purchased 80% of the share. Okay, once again, the old veterans who've been through lecture number 2 will have seen all of this before. And you will already know, therefore, that when you're calculating your goodwill and you're calculating your consolidated balance sheet, that you need to take these things into account. So your inventory has a fair value of 2,500 more than the book value, your land of 15,000 and so on. Notice that the patent has a fair value of 7,500 less than the book value. Right. I do hope those of you who've got this far and who are watching this, have watched part 2. This is part 3, yeah? Right, because you'll see what to do with these things, and it's exactly the same here. Right, the one small difference which you have to deal with. Notice that little line at the very bottom. The non-controlling interest is valued at the date of acquisition as 23.5 million. So notice that the non-controlling interest now has a value as well. Now this is new. You didn't have that before. Now what we're going to do on the next slide, which is slide number 7, is I'm going to show you what to do with that. Right, what we're going to do therefore is we're going to calculate the goodwill of the organisation, but we're going to calculate the total goodwill. So now it doesn't just relate to the sum of money that we, and when I say we, I mean company P, that company P paid. So if you look on there, you'll see that the first line is, and just to stop a second there, in terms of what we're doing, we're comparing what we paid with what we received. Now that's a little bit of a misnomer here, because yes, company P paid 120 million. Right, you know they paid 120 million because in the balance sheet of P it says investment in S of 120 million. So there's 120 million down there, which is the investment. But that only represents P's share. We have to calculate the total value of the goodwill. So therefore we add on what is the value of the non-controlling interest. And you were given in the question it was 23.5 million. So it says paid. Paid is actually a misnomer. Paid plus non-controlling interest is 143.5 million. Right, now we take 100% of the subsidiary once again, even though we only purchased 80%. Now the old way of doing it was saying we only bought 80%, so we only got 80%. Now we're going to take the whole thing. Right, so have a look at what we've done here. It says here that the shares are 50. The shares are 50 from the balance sheet. Retained earnings at the date of acquisition was 45, so the 45 is right. And the fair value adjustments are 35. The 35 is the inventory, the land, the equipment, minus the patent will give you 35,000. Add it up if you don't believe me. Therefore, the total amount is shares plus retained earnings plus fair value adjustments is 35,000. It's 130,000. So the goodwill is 13.5 million, I think it comes to, doesn't it? Get my decimal points mixed up now. So it's 13.5 million. Right, see what we've done though. We've calculated the goodwill which is inherent in the part that was purchased and in the non-controlling interest. Previously, those of you who started studying this about 5 years ago will only have done this with with what we paid. Notice how the non-controlling interest. Right, you've got to learn it. That's at the end of the day. So slide number 8 gives you your debits and credits again. Notice now that P paid 120,000 from the balance sheet. Notice at the bottom we've got non-controlling interest of 23,500. So we have to credit this value of 23,500. So therefore the total value that we're recognising in our goodwill calculation is 143,000. The 120 that P paid and the 23 that's inherent in what's left. Right, where do all your other debits and credits go? It's the same as last time. So your shares are 50, retained surplus is 45, and your fair value adjustments are 35. Right, notice therefore it's 100%. Previously we paid 120, but we got 80%, so we would take 80% of the shares. No, we're doing the whole calculation. What is the total goodwill for the organisation? Bash through your debits and your credits and you'll find that there's a missing number. Your missing number is 13,500, and that's your goodwill. Right, have a look at all of those debits and credits. Keep them close. I recommend that you actually print them, because you're going to need them for the next slides. I hope even now you've watched parts 2 and 3. If you've watched part 2, part 3 is just exactly the same now. So this here is the slide where I will inevitably struggle to get my big head onto the screen. But this is the slide that covers the assets part of the balance sheet. And now you can see in your adjustments column, once again, we've got 2,500 fair value adjustment for the inventory, 15,000 for the land, 25,000 for the equipment, 7,500 for the patent. But that's stuff that you've already seen. Those debits are going through. The investment in S has to disappear, so we credit it. Right, and if you're worried about these things, where they're coming from, go back and look at slide number 8 again. Again, it's on the website, so you can download it and have it in front of you while you're doing this. Every debit has a corresponding credit, so the debits and credits equal each other between slide 9 and slide 10, therefore, and the thing will balance. And there you see at the very bottom goodwill, and the goodwill is 13,500. And we calculated that back up. I think it was slide number 7, sound about right? Right, I hope that all of that's very clear. Slide number 10, therefore, more of the same. Once again, now you've got your two balance sheets, you've got your adjustments column, so we've got our ordinary shares, and we've got our retained surplus. And notice as well that you've got your NCIs. NCIs are your non-controlling interests, yeah? Let me just actually going to put that number in that one. I'm doing that. Right. And so you've got your non-controlling interest in there, 23,500 in your balance sheet balances. Do you see how quick and easy it is when you use this approach? And that's what this whole thing is about. Get the approach right, get those columns down on the page, put the numbers through. It almost certainly won't balance in the exam, but nobody cares. Don't even try and make it balance. Just get half of those marks and get on and move on. And that was it. There you go. How to do it. Right, once again, in the exam's going to be slightly more difficult from that. If one of the companies has sold goods to the other one, logic, you can't sell goods to yourself, then you need to take those goods out. So therefore you will eliminate the profit on those goods, and you will eliminate the profit from inventory. If assets have been transferred, you need to take out the gains on the assets. The one big thing that will have happened during the year is that you'll find again that the acquisition took place 6 months before the year end, and so therefore you need to take into account that 6 month period, because you have to calculate what the profits were at the date of acquisition. But learn your approach. That's the most important thing. Your 4 columns. Get that down on paper. Make your adjustments. Calculate your goodwill. What we're going to do now is that we're going to now do 10 questions on this. By the end of the 10 questions, you'll see every variant that can conceivably come up, and by the end of 10 questions, you'll be very, very good at it. If you have anything for me, please could you go to the company website and send it to the website. Don't attach comments to YouTube, because I don't look at YouTube that often. Okay, best of luck, guys.